Banks are closing. Here's what you need to know right now. The banking industry is facing an imminent economic depression. Due to the closure of the Silicon Valley banks, Axios has rung the alarm bells, which means that depositors are panicking. Now the Federal Reserve is pulling money out of active supply, resulting in a slimmer cash supply. Stay tuned to find out what this means for the banking industry. But before we continue further, I would like to request that you subscribe to our channel. Thank you! So, the cash volume has shrunk by over 2% year over year, which is unprecedented. We have not seen a money supply contraction in almost 100 years. This does not bode well for the banking system, seeing that this has only happened 4 times in US history. Now, before the Silicon Valley Bank was on the verge of crisis, warning bells were going off, but they went unheard. The threats of an economic depression were only taken seriously after the banking crisis hit Silicon Valley Bank. To understand what really happened, we need to revisit the reserve requirements put forth by the Federal Reserve. Typically, the Federal Reserve has a policy that states that banks should keep 10% of their net holdings in cash. These requirements were superseded due to the pandemic, and now it seems that there is a cash shortage. This means that the collapse of the Silicon Valley Bank is likely to spread to other banks because of this cash shortage. How do we know that other banks are in danger of suffering the same fate? One major indicator is that banking stocks are down quite a bit since March 13th. One stock stands out, First Republic Bank. This bank is one of the largest in the US and has more than $200 billion in assets. However, its stock is down by 37 percentage points. Investors are fearing that we could have a bank run in the very near future, are more in danger of a bank run as the tech sector is suffering from a downturn. This is not good for businesses that are reliant on cash to stay afloat, especially nascent startups that need access to cash. This puts an additional burden on these banks, particularly because the Federal Reserve has lifted all the 10% cash holding conditions. Even if these conditions were still in force, it would mean that banks would only have 10% of their total assets in cash, which is not nearly enough to give their clients their full balances, especially if they all withdraw at the same time. Since banks do not have the funds to process all of these withdrawals, it ultimately results in a banking crisis. This banking crisis ultimately results in an economic depression. Now, if we were to graphically represent the supply of money, we could see that, for the first time, a 2% cash shortage took place in the 1870s. This was referred to as the Long Depression of the 1870s. This depression was known for its huge unemployment rates. However, a similar pattern returned in the 1890s when the unemployment rates went up to 18%. All of these cycles of depression pale in comparison to the one in 1921 and the one that came after it, which we all know as the Great Depression. In the last 2 cycles of economic downturn, we saw the real estate bubble burst, the banking crisis break new records, and unemployment was so high that the government had to start sending millions of tons of food under FARA to different states to keep people from starving. Will there be a banking crisis in 2024? All signs point to yes. As with anything, there are no guarantees. Not even the most seasoned hedge fund investors would risk their reputation by making such a sweeping statement. But when we see how the market has been behaving recently, most financial observers are compelled to make such a statement. What are these market indicators, you may ask, that have investors ringing the alarm bells? For one, the Federal Reserve is aggressively increasing interest rates to offset inflation. It's almost certain that the Federal Reserve is trying to prepare the economy for the major economic shift that will rock the US to its core. Okay, now that we know that this is coming, how do we prepare for it? A solid strategy is to hold on to as much cash as possible. This does not mean that you open up a bank account and store your cash in the bank, because we just talked about all the cash stored in the Silicon Valley Bank, which went down the drain for most investors. So the most prudent strategy is to keep some money out of the bank if it's not solvent. Also, if you are not keeping that cash in the bank, then where are you keeping it? Well, experts are saying that you should stash cash away in a safe place in your home. Because if things go awry, you will need access to money. Essentially, if the banking crisis goes beyond a certain point, the government will end up reversing the things that brought on the crisis in the first place. There is another reason to keep your money out of the bank. When you deposit your money, there is no reason for the bank to hold on to it in cash. Instead, the bank invests your money and tries to make money off of it. This means that there will be a time when your money will not be in the bank. This may sound very weird, but even if it's your money, you simply will not have access to it. Now, typically, this is not a problem since the banks usually have the kind of cash lying around through which they can process withdrawal requests. But with a banking crisis at hand, what ends up happening is that people are lining up to get their money out of the bank. This creates a cash supply problem, due to which requests cannot be processed. So, people take your money out of the banks, especially the ones who are not solvent. Try to deal with cash as much as you can. Give this video a thumbs up if you found something of value in it. Thanks for watching, and we'll catch you in the next one.